Inflation's hot. Now what? Hi, everyone. Welcome to the Real Vision Daily Briefing. I'm Maggie Lake. With me today is George Goncalves, head of macro strategy at MUFG. Hey, George. Great to see you.
Yeah, great to be on with you, Maggie, as always.
So, rough day in the markets, to say the least. Stocks sold off, bond yields jumped higher after that hotter than expected reading on the consumer price index. It wasn't that much above expectations, but it was enough. It kind of felt like the market was primed for that. Fed meetings from the March meeting, Fed minutes rather from the March meeting also showed that Fed members themselves are worried inflation isn't dropping down to their target rate. And then piling on all of that was a disappointing 10-year bond auction. So just all around, a lot of fodder for those who are sort of prone to be concerned, I suppose. But what did you make of the data and what you saw in the inflation reading?
Yeah, I mean, all those things really made for a rough day for macro type traders that maybe that were at least not set up for that sort of outcome. The the numbers, I think, weren't that off the mark. I mean, there's now an obsession with this category called the super core inflation because Chair Powell has kind of clued us into focusing on this new number. Yes, and it was zero point 0.4, and it was a rounded up zero point 0.4 on both headline and core CPI. It wasn't really that far off the mark. I mean, I can go into the details if you want.
Yeah.
But it speaks to the how much the markets are on edge. Like they're on edge, and they were not set up for it. Obviously, looking at the price action, we did have a rally in rates yesterday going into it, so the setup wasn't great. Yeah, that 10-year auction, it was really just a perfect storm for a negative backdrop for rates.
Yeah. Which it's interesting to say that people were going into it not set up for it because all people have been stressed about, and the market's really kind of been sideways heading into that. There was just so much conversation about inflation becoming a problem. But the question is, where is it? So one thing I think is interesting, and we had someone just mention in the chat, this is a sort of nothing burger. Energy inflation is actually falling significantly. So if we look under the hood, we know that in some areas there is a concern about reinflation, but it's kind of like you can find your argument, which maybe is what the issue was heading into this, because some people look at other indicators, maybe ISM services prices and say, well, listen, we think that yes, they're high now, but they're turning. If we try to lean on those forward-looking indicators, what are they telling us? Is this temporary? Is this something more lasting? And are we in a reinflationary regime? How are you parsing through all that?
I mean, I don't think we're in a reinflation regime. It's just that it's not linear. It bounces around a lot, and now we're getting the echo effect of some of these sub indices that didn't have a chance, or companies and firms like insurance that had really raised prices. You're getting this echo effect of now inflation feeding through these other categories in inflation. I know you have my chart book. We can maybe look at page 3, Brian, if you want to pull it up and just look at, this comes down still to housing, the fact that it hasn't really turned the corner, or shelter costs, I should say, and how it hasn't really helped out on the disinflationary pressures. But if you strip out, housing, of course, this is when everyone starts to throw their hands up in the air and saying you can't strip out everything because then otherwise there's really no inflation. But if you look at less food, energy, and shelter, that blue line, it's been basically at the Fed's target on average. It's turning a little bit higher now, but that blue line in the CPI, less food, energy, shelter, is basically at their target. And it's going to be bumpy. And I think that there is a challenge when it comes to energy prices if we were to see an escalation in the Middle East get worse and oil prices move higher. But even just naturally going into the driving season, and if gasoline prices start moving up, the problem at this stage of the cycle, though, is that given consumers are relatively stretched, at least the lower cohorts are. If you get a move higher in energy, it's going to actually destroy demand and actually really minimize discretionary spending, in my view. And that would also fix inflation too. So it's going to be bumpy, and the market doesn't like it. The market wants a linear path to 2% and everything line up perfectly. It's not going to be like that. We've had high inflation, or not as high as what we went through, but this is not accelerating. This is just taking time to get to its equilibrium.
That's an interesting take on it. What about some of those core readings? We have Christopher just dropping some info in the chat on that. That's been worrying people who are maybe inclined to think along the lines of what you just mentioned, that listen, it's bumpy, it's not linear, but those core readings seem to be worrying people.
Yeah,
Super
the super core. I mean, these are really unique, specialized categories, and I say this, and I say this with all due respect. I mean, we were told to focus on jolts for forever by the Fed, and then they forgot about the jolts, and now we were to focus on super core. I mean, if they stop focusing on super core and they go back to their knitting, which is just normal core PCE, you're basically heading towards that 2.5-3% inflation at some point. So it really comes down to, I think, that they wanted to have a reason to keep raising rates and then keep rates higher for longer. The core on CPI is not what they track anyway. So
mm,
like there's a wedge between core CPI and PCE for various reasons. It's sticky. I get it. And it makes their job harder. At a minimum, today lowered everyone's confidence level, including my own, by the way. I mean,
mm.
we're all data dependent. Let's not kid ourselves. We're at this point now
Yeah,
that
we're all data dependent. That's right.
and you have to be honest with yourself while it's going down, but it's still 3.5, not 9.5. And this idea that we're going to go from 3.5 back to like 5 or 6, then that will just really hurt demand and actually like slow down the economy. So yeah, if inflation spirals from here and I'm wrong and the Fed stays on hold for longer, then that increases the chance of things breaking in CRE and housing market again, and credit will not be able to survive with rates this high.
And that is the what now that we were referring to in the and we'll get into that market reaction in just a bit. Want to ask you about payrolls, about employment. So, we have it's the wage inflation part of this is such an important part because it is considered structural and sticky, hard to roll that back. We know energy goes up and down. We have a lag with shelter, but that wage inflation part traditionally is something that really concerns the Fed. What's your read on what's happening in the labor market? Because that's been a little murky to figure out too.
And it's been murky, and also the Fed has now also clued us in to think about that they have a dual mandate and that they are equal or now starting to become a balance of risks, equally concerned about what's truly happening in the labor market vis-a-vis inflation. This wage price spiral thing is a very 1970s concept. It's always, and it's part of the Phillips curve concerns, and they're always worried about that. If you have a really tight labor market, it's going to generate inflation and becomes this like, self-fulfilling prophecy. But I mean, it's still, I mean, you can't use the word transitory because then you're going to get chastised. But I mean, it is very, unique to what we've experienced. And if you look at the labor market, let's look at, chart 5, for example, in the deck. It's perplexing because we're getting these mixed reads. We're getting this like this kind of divergence between what the actual NFP is telling us and what other measures are telling us. And then if you really go under the surface, you're noticing the part-time versus the full-time, which has been highly scrutinized and covered both on X and everywhere else. And I have my own versions of those charts. The truth is probably somewhere in the middle that we don't have as robust of a jobs market at this stage, and it's probably the best that we're going to see at this stage, and therefore wage pressures from here. I don't see it taking off from here. And if you go to the next slide, on slide 6, and look at the actual full employment landscape between full-time work and part-time work, that bottom half of that chart, you're seeing a pretty decent divergence between full-time and part-time work. And people can say, oh, this is by design. People want to work less. And people would rather have full-time benefits and everything else. I don't buy that argument. And if you then move to the next slide on page 7, this is why one of the biggest enigmas or anomalies. We have stock market at the highs, apparently full employment, and everything's hunky dory. Why is consumer confidence still so low? Why has it been so low? And if you look at slide number 7, this is the annual growth of full-time employment, which turned negative in the last few months, and it has a very good correlation with consumer confidence. I mean, I think all this stuff makes very logical sense. If your outlook on life and the economy is that you have full-time employment and you can maintain your bills, you don't have to take on 3 jobs to survive, I think then your confidence goes up. And on top of that, we had a big inflation scare, which still haunts most U.S. households. And they're like, look, we have high inflation, and I'm worried about the jobs outlook. Maybe this is as good as it gets, and stocks are at the highs, but I can't consume stocks. I have to actually have a paycheck.
Yeah. Yeah, and by the way, if you're not employed, and you mentioned that really important benefit component, if you're not employed, guess what? You're not participating in 401 too. So you've got to, fund your own, which is a lot. I'm not gonna say it's harder, but there's a jump then, and when you're doing that
100%.
and you're having to put out healthcare costs, the chance of you really contributing greatly to your 401. This is a very American dynamic, but it's extremely
Yes.
important that you bring that up, and you're absolutely right. Faced with no benefit or retirement, that is extremely difficult for people, and I think there's a lot more worry about the future. You're essentially, even if you're making a higher salary, living paycheck to paycheck because you're concerned about covering an unexpected cost or having to cover a much higher cost for insurance and potentially 401 with no match than you would if you were part of a full-time situation. So I think that is it's we don't have, it's harder to track, but you're right. Would understand why there's a correlation on that. What does that mean? How does that look? Does that move around, or is that a consistent trend? That's where it's a little bit more difficult, but
Working.
really,
Yeah.
really great to raise that point. So, what do you think this means for the Fed? Because they've got to be sitting there grappling with all of this too, since some of the models just don't work as well as they did before.
Sure. Again, this like the key word that they've been telling us all along. They need greater confidence, and now this might be a setback. And it really then calls into question how do you actually launch an easing or cut rates, because they're not going to want to claim that this is an easing cycle, because then the market's going to run to a whole other level.
Well,
And so
they
they're going to be like,
caused
look,
that in the beginning. By the way, the reason everybody was anticipating that linear drop in inflation is because they said they were going to ease.
yeah. Yeah, no, so yeah, there's a little bit of circular logic here and arguments going on at the same time. But this is where this is why they have multiple Fed speaker parades every so often, because they're trying to calibrate the message, and the message which we got from the minutes, and we got a further read on it. They're not ready yet to kind of really move down the road of cutting rates, but they know that rates are restrictive, but it's not working through the traditional channel. Like everyone says, the U.S. is not rate sensitive. I was like, it is rate sensitive, but for different cohorts. Yeah, if you're locked in and you have a 3% mortgage, good on you. But everyone else that didn't participate or is not now able to get into the housing market because affordability is the worst it's been in ever, like that really then changes the dynamic of the U.S. economy on a go-forward basis. So rates do matter. They've now kind of like created what I call the have and have-nots. Many others have used the same reference. We have a bifurcated economy. We have an economy that is really geared towards those that have balance sheet and assets, and they're benefiting from that. And everyone else is really income dependent. And so then when you have to take on debt to like maintain your lifestyle or just maintain life, just like bare essentials, the interest costs matter. And we're at this stage now where interest costs are really starting to hurt the lower end. And I think that will end up with reduced consumer spending. And then of course Uncle Sam. I mean, U.S. government also is paying high interest costs too. So rates matter. They're going through different interest rate channels, and it's taking longer to show up. But doesn't mean they won't. And that's why I feel like they should still ease. But getting like when to ease is gonna be so hard. I mean, I was in June. I mean, June, July. I mean, I think it still makes sense to ease. But if we keep getting readings like this, they're gonna push it back.
So, I want to ask you about the bond market in just a moment, but you have a chart about that, the rate, because this rate impact, it's really interesting because the economy's been so strong. People are kind of like, oh, the economy can handle it. It's
Right.
fine. Other people we've had on are not as sure. They feel like that role is longer than maybe people thought. And
Yeah.
yes, the 30-year mortgage is a different story. But even the haves have to have cars. Very few, maybe everyone pays cash for them at a certain income level, but a bunch of people, even if they're in a really good mortgage, have to have
Yeah.
cars. They potentially student loans. There are other credit card debt. There are other forms
That's
of
right. That's
debt that
right.
they're taking on. So how
Yeah.
are we shaping up,
Yeah.
even if you take the mortgages out of it?
Yeah. So I think, if Brian looks at page 8 and we pull it up and focus on it, and this is a chart from Bloomberg, and we looked at the mix between what the average household is spending as an interest cost, what's their budget towards interest expense on a running basis. I hate to use averages because again, there's no average in the US. Some are able to afford things and some are really not. But on average, non-mortgage related interest is at the highest it's ever been. And it's nearly half of what a typical household is paying now between auto loans, credit cards, car loans, personal loans, you name it, buy now, pay later. I mean, so now interest will start to really matter for those, and some of those don't own homes either, and they're renting, and so they're never going to be able to really participate in the housing side. So, like, I think that rates matter. I think the Fed has to cut rates, from what you could probably tell,
Yeah.
and they have to steepen the curve, and they have to make it more affordable for everybody else. But with inflation running the way it's been, it just pushes it back. And my concern is the more they push it back, they're going to have to either cut faster, but then they're going to be reacting to a slowing economy, and that'll be really unfortunate.
Yeah, and we if we remember at the beginning with, Jay Powell, he was talking about getting ahead of that slowdown, trying to really engineer that soft
That's
landing and the
exactly.
lag, and, we all talked about how different that approach was, but now without the cooperation of inflation, perhaps, that's off the table. So the market definitely changing its expectations today, um, reducing the possibility of a June rate, now putting the highest probability on something in September. We know this starts to get messy because traditionally the Fed doesn't like to do something right around election time. You've got that complication in as well. What is the bond market? Do you think that we saw yields go up? Do you think that we're headed back to 5% on the 10-year?
So, I mean, like the 10-year got to some really critical levels today, like 455. We're at this upper channel. I mean, it should start consolidating here, because if it doesn't, there is that risk towards a gap towards like 475. And that's not something to kind of scoff at, because if you remember from November 1st until now, and the big first start of the rally in both credit, and then which helped out equities and everything else, was tens went from 5 to 3.75. Then it
Mhm.
stabilized somewhere around 4 and a quarter. Nobody really paid attention. Like, all right, as long as tens are in the fours, low fours, and we'll keep buying stocks and equity and credit, right? But if it starts to go back up again and it doesn't feel like it's going to stop, this is where the three macro, the trio of the three macros, which is the 10-year rate, the dollar, and oil. Those three things can fast track a pretty big risk reduction in the market, and markets are priced really high and really extreme valuations, and that would also impact macro activity too and growth. So I'm really concerned about a gap on the 10-year, but given how much we've moved, I think we should probably consolidate a little bit here. We had the auction, we have a 30-year as well coming up, and I think cooler heads prevail. But if they don't, then the risk is that it will start to then impact risk assets even more severely, because a 1% move on the stock market is not a big deal considering what happened in the bond market today.
The dollar. Ched asking, what do you see for the US dollar in the next 6 to 12 months? Dollar shot higher today.
Yeah, so this is to go back to answering your bond question. I'll tie it back to the FX question, and it's so the bond market now is also losing confidence, as you could tell. So we're pricing out the cuts, and we're doing it in a very linear fashion. We're not assigning, like, hey, what if they do cut in July or September, then they take a break, and then they come back to it. We're just pushing things back because no one really has strong conviction here, and
Mhm.
positioning is really showing that, and just the flows where and the price action, I think, dictates that. So if the bond market just keeps pushing back the rate, the start or the first cut, then that just will further strengthen. It'll keep the dollar a bid throughout that period. The dollar can't weaken until the Fed starts cutting in a meaningful way. So, and then of course you have gold, and of course I'm sure you have people that have questions around gold, because that's completely going at odds with what rates are telling you gold should be doing. And then brings up the question that is gold more of a medium-term outlook about, hey, we know the end game. It has to be eventually they're going to have to cut a lot more, because the longer they wait, things are going to break anyway. And therefore it's going to be financially inflationary, maybe not real inflation, because they'll have to print money again. But while we wait, the bond market and the FX market are just kind of connected at the hip here, where they need to just if they push back cuts, then the dollar can't weaken, and that's an issue for all these countries that are now facing some currency pressure.
Yeah, and we have we've been talking about the potential for global banks to not finally not move in lockstep. This raises the issue that maybe some will move before the Fed, and if they don't, that's both of them have potential outcomes. Is there an opportunity in there, or is it more of a risk? How are you looking at that?
I mean, like the cheapest like vol, and it's for a reason, has been FX volatility. So, like FX vol could be like a hedge towards all other hot vol, like the VIX or rates. It's been stable because the belief that everything's going to be synchronized and it's going to be smooth sailing, and it's going to be a perfect soft landing everywhere, and that central banks are going to have kumbaya and cut rates. But if everyone goes at a different pace, that does create FX volatility.
Yeah, so maybe one place to watch. So back to gold. If you think gold was sort of sniffing out past the part we're in now, and they're looking beyond that to say, all right, you know what? One way or the other, doesn't matter, we get there, we're going to be in easing. I think you have a chart with forwards for the as well that have been not so sure that we're
Yeah,
higher for longer. So is this just a
yeah,
time
exactly.
frame issue?
I mean, ultimately it is because it comes down to when they start, how much do they cut, and where do they stop, right? That's really what we're trying to solve for.
Hmm.
And the bond market is super focused on that, and that's what we're debating internally, and that's why we're seeing these repricing happen so often, and these data points become very binary. Like today is a binary event. You go in thinking something on CPI and something else happens. I think, as I think I said at the beginning, I think it's an overreaction, and the market wasn't probably set up the right way. But either way, the market moved. You have to respect it. But if you look at that page 9 and look at like what the forwards have been telling us, the forwards are still telling us that the real neutral rate is somewhere around 3.5, 4%. At least short-term neutral. I don't think that's the neutral for long-term for where rates will be in the U.S. I still believe in some of the demographic issues, and we could debate like the structural changes in the economy. But if we also embrace AI slash technology as disinflationary, like a lot of these things kind of offset each other over time, and then you come back to almost square one that maybe rates are a little bit higher, but not that much higher. Meanwhile, the Fed still has rates at 5.5, but the bond market's been trading in the fours forever, signaling, hey, you're too restrictive, that this is not sustainable. And the forward rates have been saying the same thing. The question is, do you get there gracefully and you cut like 25 every other meeting and you really have that nice soft landing? Or do you end up realizing, wait, we were at 5 for too long, and then they do 50 basis point cuts in the end of the year because they have to catch up?
I think that's a great way of putting it, George, because the things that seem so at odds just may be, and it often comes down to this, the time frame you're operating in. And I think you just laid out what the risk is, right? So the people who are short term saying there's no way the Fed can cut, this is a reinflating, hotter than expected economy, or they shouldn't be cutting. That is in the shorter term, and we can argue about what that means. Let's just even say for the next 6 months or so. But the people who are looking at the end of 24 into 25 are like, listen, this is coming. When you say, um, when you say the neutral rate is at 3.5, 4.5, ultimately, I don't think it's going to stay there. You think it will be lower because of some of
Right.
the big structural issues you talked about, technology and demographics. You think it ultimately sort of does drift back down to that lower range.
Yeah, and look, the Fed hasn't come clean yet either, and they're debating. So my initial thought process, and it's still roughly what I believe in for the near term, is that and we heard it from the minutes, which I'm sure we can get into it if you're interested. In the minutes, they talked about QT. That's the first thing that they have to address. They have to slow down QT, and I think that they'll do that. But the and we heard that from the minutes today as well, that they're contemplating going down in half. Right now they're roughly about 80 billion. The actual speed limit is like 95, but they don't hit the speed limit because mortgages are not prepaying. But nonetheless, if they cut down the QT, that's the first policy change. And then
Mm.
the next one will be right. And then after that, we have Jackson Hole in the summer. And like the ideal thing for the Fed, in my view, would be like you start the process, maybe June, July. But right now, this is now debate considering the CPI we had. But if PCE comes in closer to their expectations, the market can flip the other way too. So this is a very binary market.
Well,
But
we've seen that.
nonetheless,
We keep saying they're running from one side to the other, right? Of the but which for the bond
exactly.
market is not always something that happens, but
Yeah, and the bond market is big, so like it's like the Titan, or whatever. Yeah, it's like a big boat moving back and forth.
yeah.
But
I like how you
it,
rolled back that Titanic because sometimes it feels like we're
yeah,
on
yeah,
the Titanic. Um, I want to talk about
exactly.
stocks. We didn't even talk about, so you could say that what the Fed's trying to do, but then there's this unpredictability of the fiscal spending, which is on a lot of people's minds, especially as we're heading into election. Hard to game that out because it doesn't seem like anyone's
Yeah,
remotely interested in taking their foot off the gas with that. So that's going to work against potentially the Fed wanting to ease. Um, Stocks. I just want to circle in on this because most people hold those in their portfolio. When we talk about the potential pain, How vulnerable is the stock market? We saw this play out really for the better part of more than a year, where as the bond market or bond investors run from one side to the other and whip that yield around, it's been super painful for stocks. We were at those record highs. How vulnerable are we for a sizable correction if the bond yields continue to go higher? And does that is that just a healthy correction, or does that create something that becomes more self-sustaining because of some of those confidence issues?
Yeah, so I threw up the trio of the 10-year oil dollar, right? Those things are super critical, and they can both go up and be like on fundamentally that's not consistent in the short run. It can happen though. You can have a situation where oil, because of geopolitics, you can have a situation on a dollar just catching a bid and rates being higher. The sort of loop. I do want to tie in the QT to the stock market part. If you look at page 11, because I do think it's related, and this is where they could just be another kind of problem to contend with. We have April 15th tax payment coming up. There's a lot of gains from last year. We have QT still in place. The Fed is discussing that they're going to be reducing the QT, but they haven't done it yet, and it most likely either is announced in May or June and starts in July. But if you look at that chart that Brian's pulled up there, slide 11, the black line is the bank reserves. They've been pretty much stable throughout this whole up down move in stocks. We had a over $20 trillion swing in the market cap of the S&P, and now bank reserves haven't really gotten hit, and it was mostly RRP that adjusted to the Fed's sort of actions of QT. But going forward, we have like a potential for April into May, a pretty big liquidity drain at the same time where bond rates are moving up in the wrong direction. Like that, I just don't see how stocks can handle that, considering where valuations are. So yeah, I do worry that this is kind of like the perfect setup for people who usually sell in May, but they'll probably sell in April. And like you get into that environment where you kind of pull forward the activity. That seasonal bias gets pulled forward. People just say, "Hey, it's been a good run. I'll take some profits here." And the stock market at a minimum can go down 10%. I wouldn't be surprised. And I think that's probably what we would be facing.
Yeah, and a lot of people are concerned about locking in those gains, because that sort of overhang. I mean, even for the people who feel like they're doing well and are sitting in those assets that are performing, nobody wants to lose the gains they're sitting on. And so that has been consistent. One of the biggest questions we get all the time is, should I take my profits? Should I sell? Should I take my profit? Should I sell? So that we know just anecdotally from our viewers that is absolutely, and rightly so. Nobody wants to suffer that drawdown, so it's a perilous time for sure.
Yeah, and you
George?
mentioned fiscal policy. I'm not sure if
Yeah.
you want to touch on that really quick before
Yeah,
wrapping
let's
things.
finish up on that because everyone's like,
Yeah,
"Wait, the economy's so hot." Well, you can say that the monetary, situation is tight because we've got fiscal that has not been. And so,
yeah,
those 2 have been working against each
yeah,
other. Certainly, the fiscal's been working against attempts to tighten on the monetary side. So what do you see there?
exactly. Yes, that's why maybe if you go back one slide to slide 10, I mean, to try to make it simple and show the point that like last year, in many ways, all the fiscal policy offset the Fed's tightening. And
Mhm.
so what I'm showing you here is a lot of different lines, and your readers can look at it. But basically, the QT is probably worth 100 basis points of tightening. The Fed's at 5.5. That's 6.5% rates, and that's very close to what the San Francisco Fed's proxy for Fed funds is. And we have mortgage rates that are high, so rates are definitely high. We can't deny that fact, right? But yet we haven't really felt that sort of slowdown in the economy because of the fiscal side. And so what I try to do here is calibrate for what is the fiscal worth in terms of yield equivalent, and it's worth about 87 basis points, 200 basis points. Man, it's a lot. Basically, the U.S. government's easing and the Fed's tightening, and that's what led to this big tug of war, and it led to what I call like the sugar high of performance in the economy, and it's spilled in a little bit into this year. But we're going back to 2% growth rate. That's nothing really to write home about. That's our average speed limit is 2%. It's really the inflation thing. Once we get inflation back down, there's no reason for the Fed to be at 5.5%.
All right, we'll see. George, fantastic day to have you on. Thank you for sharing all that really good data and all of the thoughts. And I think that idea of looking at it in that time frame. We talk about this all the time when people are investing to think about their time frame, but also super interesting to see some of the market function and reaction from those who have a view and are pricing short-term issues as opposed to some of the parts of the market that are seeing through that. So really good. And let's hope there's not the pain you talked about, but it's certainly something we need to be on guard for. Thanks so much, George.
For having me.
We love having George on. And thanks to all of you for the really robust chat today. I could barely keep up with it and all the great questions. We appreciate it. We will be back tomorrow. Raul's having a crypto summer drinks AMA right now. If you want to jump over for that, I know a lot of you are following that space and interesting to hear what he's thinking about on some of those time frame issues. So go ahead and have some fun. I said it was happy hour in the chat. It wasn't too early in the week. I guess I'm right. So enjoy, everybody. Thanks, George. Take care, everybody.
Thanks.